Hello everyone, welcome to the 138th episode of me learning how to trade in Forex. So in the last episode we went through what is a trading plan. Basically, having a suitable trading plan is one of the most important aspects of trading. It's there to act as your own personal decision making tool, helping you answer vital questions like what, when, why and how much to trade. And your trading plan should cover your personality, attitude to risk, trading goals, risk management rules and any trading strategies you intend to follow. And it's really important for your trading plan to be personal to you. So it's no good copying someone else's plan because that person will very likely have different goals, attitudes, and ideas, personalities to you. So they also have different amount of time and capital to dedicate to trading as well. And then there's also been three terminologies being thrown around. So trading strategy, trading plan, trading diary. We went through what each of them are. Watch the video, we learned about why trading plan is important, so it makes trading easier, helps you trade without emotion, and helps you maintain discipline. And it also enables you to improve by seeing your past trades, so you can reflect upon it. And then we went through the lesson summary. So now we're on to how to make a trading plan. So, how to make a trading plan. Date is the 17th. Alright, let's get started then. How to make a trading plan. All trading plans are personal and unique, so there's no set formula for creating the perfect plan for you. However, most should address the following in some capacity. So a trading plan should address the following. Motivation. Why do you want to become a trader? Is it for the money, for the excitement, or simply to learn more about how the financial markets work? Whatever it is, it's a good idea to write it down because your motivation is an essential part of who you are as a trader. Why do you want to become a trader? It's a good idea to write down the reason as your motivation is an essential part of who you are as a trader. Time commitment. Before you get down to the real business of trading, it's sensible to work out how much time you can commit to it. Individuals looking to make a large number of trades per day, for example, will need to dedicate a lot more time to trading than, let's say, investors looking to buy assets that will appreciate over several years. It's also important to spend enough time preparing yourself for trading, which includes education, practicing your strategies, and analysing the markets. Work out how much time you can dedicate to trading. It's also important to spend enough time preparing yourself for trading through education, practicing your strategies, and analyzing the markets. Trading goals. Once you've written down your motivation for trading and the amount of time you're willing to commit, you can start defining your trading goals. These goals shouldn't simply be grand statements about how you're going to buy a big house or yacht with your winnings. To be effective, trading goals need to be specific, measurable, relevant, and time-bound. In short, they need to be SMART. Trading goals. So, define your trading goals. These trading goals need to be specific, measurable, attainable, relevant, and time-bound. SMART. Question: which of the following statement is a SMART goal? I want to increase the value of my portfolio by 10% in the next 12 months. I want to get rich quick. Top 1. First statement is a SMART goal. The figures are specific. You can measure your success. It's attainable, assuming you have enough trading capital to start with. It's about trading, so it's relevant. There's an explicit time frame. Cool. Attitude to risk. Market prices are always changing, and even the safest financial instruments carry some degree of risk. An investment that seems like an exciting opportunity to one person may feel dangerous and stressful to another. So before you start trading, it's important to work out how much risk you're prepared to take on, both for each individual trade and over your trading strategy as a whole. Your attitude to risk usually goes hand in hand with your trading goals. For example, a trader looking to make 100% returns every year might be happy to take on increased risk to achieve the objective, while a more conservative investor might only want to risk a small amount of investment capital to realize 10% yearly growth. Work out how much risk you're willing to take on, both for each individual trade and over your trading strategy as a whole. Your attitude to risk usually goes hand in hand with your trading goals. For example, your attitude to risk usually goes hand in hand with your trading goals. Cool. Trading capital. Now it's time to get serious and look at money. Specifically your money and how much of it you can afford to dedicate to trading. This is your trading capital. How much money you can dedicate to trading. It should go without saying, but it's vital that you don't risk more than you can afford to lose. Don't risk more than you can afford to lose. While no one trades to lose money, you need to be aware that some traders do end up losing their entire trading capital, and sometimes a lot more besides. You will always need to make sure you can afford the maximum potential loss on every trade. So do the maths every time you open a position. If you don't have enough at the moment, practice trading on a demo account until you do. So you always need to make sure you can afford the maximum potential loss on every trade. So calculate it before, calculate it every time you open a new trade. If you don't have enough capital Practice on a demo account until you do. Markets to trade. With so many markets available, how do you choose which one to start with? Research is an essential part of trading, so it makes sense to begin by looking at the markets you have a particular interest in. If you'd like to keep up with technology trends or retail companies, for example, then trading on stocks in these industries is likely to come more naturally than speculating on commodities such as corn or cattle. Research which market you have a particular interest in. It's also crucial to look at the following: trading times. When is the market open? Volatility. On average, how many points does this market move in an hour, day/week? Position size/contract size. How much will you gain or lose for every point of movement in the price? It's also crucial to look at the following. To look at the trading times, so when is the market open? Volatility. On average, how many points does this market move in an hour, day/week? How many points does this market move in a hour, day/week on average? How many points does this market move? Position/contract size. Position/contract size. How much will you gain or lose for every point of movement in the price? You gain or lose for every point of movement in the price. If these factors don't fit in with how you want to trade or your attitude to risk, then pick another market. If these factors don't fit with how you trade, how you want to trade, or your attitude to risk, then pick another market. Once you've made your decision, it's important to stay focused. The more you understand about your market and why the price moves, the more likely you'll be able to predict future movements with accuracy. Once a market is chosen, stay focused on that market, as the more you understand about that market, and why the price moves, the more likely you'll be able to predict future movements, future price movements with accuracy. Once the market is chosen, stay focused on that market, as the more you understand about that market and why the price moves, the more likely you'll be able to predict future price movements with accuracy. Cool. Cheeky little video.
The financial markets, a world of opportunity, tens of thousands of assets to choose from. So how do you narrow it down? First, pick an asset class. There are 4 main types: shares in individual companies listed on stock exchanges around the world, stock indices, figures representing the top shares from a particular area, exchange or sector. Forex, the value of one currency compared to another, like the pound versus the dollar or the euro against the yen. And then there are commodities, such as gold, oil, natural gas or wheat. Now look at what interests you and what knowledge you already have that can help. Say you were thinking of trading gold. Do you know which factors and global events drive precious metal prices and why? If not, do your research. Source reliable information, look at charts, analysis, past history. Try to get a feel for the market and what it might do next. Now think about the market opening hours and whether they fit your lifestyle and schedule. Shares and commodities are traded on exchanges which tend to have fixed hours. For example, the New York Stock Exchange is open from 9:30 a.m. to 4 p.m. Eastern Time. Are you free to trade during that period? Forex markets, however, are available around the clock. How do you feel about trading something that's always active, where the price can move at any time? Then there's risk to consider. Look at the volatility of a market, how much the price moves typically in a day. Are you comfortable with that range? Some markets react dramatically to events such as economic data releases. Say you were planning a trade on a US index like the Dow Jones. You'd need to be aware of any upcoming events that could affect it, like the non-farm payrolls, for example. And you might want to try and capitalise on Dow volatility after the release, or avoid that risk. Last, look at the costs of trading. Check for any commission or spread your provider applies, and make sure the minimum trade size suits you. If you're trading using leveraged products like spread betting or CFDs, the cost of trading is generally cheaper and potential rewards greater. But remember, you can lose more than you deposit, and the higher the leverage, the more risk you're taking on. So it's important to use risk management tools such as stop losses. So to sum up, only trade what you know and what you've researched. Also think about the opening hours and volatility of a market before weighing up the costs. If you choose your markets based on the facts and not gut feelings, you'll have the best chance of success as a trader.
Cool. So, record keeping. For a trading plan to work, it needs to be backed up by a trading diary. So, for a trading plan to work, it needs to be backed up by a trading diary. This is where you record everything that happens during a trade, including why you entered it, the expected profit and maximum risk, the entry point, exit point, and how the market behaved during the trade. You should also record how you felt before, during, and after the trade, as this will help you keep your discipline and avoid making decisions based on emotion. So, in a trading diary, record everything that happens during a trade. This includes why you entered it, why you entered the trade, the expected profit and maximum risk, the entry point, exit point, and how the market behaved during the trade, trade. You should also record how you felt before, during, after the trade. How you felt before, during, and after the trade, as this will help you keep your discipline and avoid making decisions based on emotion. If, for example, you closed the trade early because you were afraid the market was going to turn, write that down. Did the market continue in favor to reach your target level, or did it move against you as you thought? Record why you decided to deviate from your plan. Did your emotions get the better of you, or does your plan need revision? Record keeping also enables you to see how you're performing over a period of time. Are you generally profitable, or are you losing money? What's your win percentage? When you win, is it usually by more or less than when you lose? Are particular market / times of the day / trade setups more profitable than others? Record keeping also helps you analyze your own performance. Are you generally profitable, or are you losing money? Are you generally profitable, or are you losing money? What is your win percentage? When you win, is it usually by more or less than when you lose? When you win, is it usually by more or less than when you lose? Are particular market / times of day / trade setups more profitable than others? Are particular markets, time of the day, trade setups more profitable than others? Keeping track of these statistics will enable you to become a better trader and help you on the way to achieve your goals. So, lesson summary. All trading plans are personal and unique, but should cover your motivation, time commitment, trading goals, attitude to risk, trading capital, markets to trade, and record keeping. So, what is risk management? What is risk management? Prices can go up and prices can go down. One of the key parts to a successful trading plan is to ensure you manage your risk properly, because as any trader who's been in the game for long enough to will know, you can't get it right every time. Right. So, pricing wanky enables you manage your risk. Ensure you manage your risk properly, as you won't always be able to you aren't always right every time, as you aren't always right every time. Yep. In finance, risk is defined as the potential for the actual return on the investment to be lower than the expected return. Risk is defined as the potential for the actual return on an investment to be lower than the expected return. This includes the potential for a loss, and if you're trading using leverage, the potential to lose even more than you put in. Risk management is a set of rules and measures you can put in place to ensure the impact of getting a decision wrong is manageable. Risk management is a set of rules and measures you can put in place to ensure the impact of getting a decision wrong is manageable. In fact, traders with particular effective risk management strategies can still make money even if they lose more trades than they win. That's because their winning trades are, on average, more profitable than their losses. We'll look into how that works a bit later, but first, let's run through the three main types of risk you can come across when trading. Three main types of risks occurring during trading. Market risk. By far the most familiar type of risk is market risk. This is a possibility you will suffer losses due to movements in market prices. The possibility you will suffer loss due to movements in the market price. The four factors that have the greatest impact on market prices are, the four factors that have the greatest impact on market prices are interest rates, stock prices, foreign exchange rates, and commodity prices. It's worth noting that these factors do not directly have to change the price of the market you're trading to have an effect. It's worth noting that these factors do not directly have to change the price of the market you're trading to have an effect. For example, if you're trading a US stock from the UK, your profit or loss can be affected significantly by the GBP USD exchange rate, even if the market price of the stock stays the same. Oh, right, okay. Similarly, market prices can be influenced by many different elements working together or against each other. If you're trading on a major mining stock like Antofagasta, for instance, commodity prices will have a large effect on its share price, particularly copper, as that's the main commodity the company produces. As most commodities are denominated in US dollars, the strength of the dollar will have a significant bearing on the commodity prices and in turn the stock itself. Also, shifting monetary policy in China could potentially boost or dampen building expansions in the country, increasing or reducing global demand for commodities as building materials. This again could affect the mining company's share price. So it's important to recognize that market risk can come in from a number of different sources, some of which may not be immediately obvious when you first look at potential trading opportunities. These factors do not directly have to change the price of the market you're trading to have an effect. Similarly, market prices can be influenced by many different elements working together or against each other. Market prices can be influenced by many different elements working together or against each other. As most commodities are denominated in USD, the strength of the dollar will have a significant bearing on commodity prices and in turn the stock itself. As most commodities are priced in USD, the strength of the dollar USD will have a significant effect on the commodity prices and in turn the stock itself. Also, shifting monetary policy in China could potentially boost or dampen building expansions in the country, increasing or reducing global demand for commodities as building materials. This again could affect the mining company's share price. So it's important to recognize that market risk can come from a number of different sources, some of which may not be immediately obvious when you look at potential trading opportunities. It's important to recognize that market risk can come from a number of different sources. Some of which may not be immediately obvious when you first look at potential trading opportunities. Some of which are not immediately obvious when you first look at potential trading opportunities. Liquidity risk. Less well known but still very significant is liquidity risk. This is the risk that you can't buy or sell an asset quickly enough to prevent a loss. You can't buy or sell an asset quickly enough to prevent a loss. You can't just buy or sell an asset quickly enough to prevent a loss. You can't buy or sell an asset quickly enough to prevent a loss. There are two main types. So asset liquidity risk refers to the asset's ability to be traded in the markets. If, for example, you have a little known stock, if you hold a little known stock and nobody wants to buy it, you may be forced to sell at a less favorable price. This type of risk tends to only be an issue in emerging or low volume markets. Refers to the asset's ability to be traded in the market. This type of risk tends only to be an issue in emerging emerging or low volume markets. Funding liquidity risk. So, funding liquidity risk. The potential for a loss if one of the parties involved in the trade cannot meet their financial obligations when they need to. The resulting time delay could have an impact on market prices, or may cause the trade to fall through altogether. So, the potential for loss if one of the parties involved in a trade cannot meet their financial obligations when they need to. Cannot meet their financial obligations when they need to. One of the parties on a trade cannot meet their financial obligations when they need to. The resulting time delay could have an impact on market prices. Could have an impact on market prices. Or may cause the trade to fall through altogether. Or may cause the trade to fall through altogether. So the trade won't even happen, basically. Systemic risk. Oh, so no, I can't scroll down. Systemic risk. Finally, there's systemic risk, the risk that the entire financial system will be affected by a particular event or series of events. The risk that the entire financial system will be affected by a particular event or series of events. Particular event or series of events. This occurred during the global financial crisis of 2008, where subprime debt issues and the subsequent collapse of major financial institutions such as Lehman Brothers caused stock markets to drop worldwide. Subprime debt issues and the subsequent collapse of major financial institutions. As its effects are global, systemic risk is very often difficult to protect yourself against, though investors with more diverse portfolios tend not to be as badly affected as those who invest in just one sector or asset type. Other examples of systemic risk can include natural disasters, war, and major political or regulatory change. A major political or regulatory change, as its effects are global. Systemic risk is often very difficult to protect yourself against. Risk is often very difficult to protect yourself against, though investors with more diverse portfolios tend not to be as badly affected as those who invest in just one sector asset type. Though investors with more diverse portfolios tend not to be as badly affected as those who just invest in one sector or asset type. Other examples of systemic risk can include natural disasters, war, and major political or regulatory change. So, other examples of systemic risk can include natural disasters, war, and major natural disasters, major political or regulatory change, and war. Risk management is a set of rules you can use to ensure getting a decision wrong is manageable. Market risk is the potential to suffer loss due to movements in market prices. Liquidity risk is the potential to suffer loss because you can't buy or sell an asset quickly enough. You suffer loss due to movements in the market price. Potential to suffer loss because you can't buy or sell an asset quickly enough. Can't buy or sell an asset. So the possibility you will suffer loss. So liquidity risk, the possibility you will suffer loss. The possibility you will suffer loss is you can't buy or sell an asset quickly enough to prevent a loss. The potential to suffer loss because you can't buy or sell an asset quickly enough to prevent a loss. Okay. Systemic risk is a potential for the entire financial system to be affected by an event or serious events. The risk that the entire financial system will be affected by a particular event or series of events. Cool. Okay, that was a long time to load. But I am going to leave this episode here. So in the next episode, we're going to go through ways to manage risk, part 1. Yeah, we're going to go through that. So thank you all for watching. Bye bye.